Hello everybody, welcome to another update on the Gold Forecaster Index, the holy grail to predicting gold prices. In my last video I said that everyone should take a look at bond yields because those bond yields will lead the gold price. And apparently the bond yields have been flat and that has been very good for the gold price. So gold has actually moved higher since last month from here to here, and it looks like we are starting to break out. So let's take a look at the data. So the latest data point for the gold forecast index is actually negative. I've also changed the formula a bit. So I did a 0.25% multiplier to the 10-year yield because I thought that the 10-year yield was too volatile. So I have decreased that a bit. Still, we see that the gold forecaster index is pointing down. We are still positive, but we are in the situation like in 2010, where the index went down. Now, the gold price still went up in 2011, but you can see that this index went negative at some point. So we could see it play out again, that this goes back negative, and then you should watch out, okay? We are still not there yet. It could be that gold price could rise a year or two, but you need to watch what happens here. This is not a good sign if you see this index go down. Could be that next month this points back up, but watch this. The tail roll rate is still positive. That's good for gold. Misery index, we still see inflation pointing up. And the latest jobs numbers were also not that great. So I think this is still positive for gold. Real output, I'm seeing that the real output is improving. So that could be a bit negative for gold. Supply and demand, we don't have extra information there. GLD, we have seen an uptick in gold buying from investors, but it has gone down a bit again in the latest weeks. So not sure if these institutional investors will keep buying gold. We will see. At the COMEX, we see that registered buying has gone up a bit. That's positive for gold. The latest China demand was not that great. So in May, we saw that SGE deliveries were down from April. They were still higher than last year May here, but the trend is back down. So that's not that good news. What can we say more? This is an interesting chart that tells us that silver has been leaving the COMEX and going into PSLV. So they're going physical now, which is a very good sign that silver is probably moving higher. Central bank gold demand, I will talk about that later. The premiums on silver have gone down a little bit from 50% to 45%, 46%. I expect that these premiums go down more and we will see silver go up if that happens. Premiums in China are a bit down. Same here, gold premiums are also down, but the history tells us that premiums still need to go to 3% and we are now at 6%. So there's still enough upside in gold and silver. I'm pretty optimistic here. Open interest, gold COT report has been a bit negative here. I had hoped that the commercial shorts would cover more, but we're still seeing a lot of shorts here and silver as well. So that's a negative. Same here in the managed money shorts. Gold, all the shorts are gone here. So that's negative. In silver, it's a little bit better. Here we see a lot of silver shorters, which could give a short squeeze. What do we see here in the LIBOR rates? LIBOR rates are going down, so this is typically positive for gold. Lease rates, nothing to see there. Then we have the tips. So we saw here on the tips that gold has been going higher while the tips has been flat. So I think gold has been going up too fast. So we need a small correction back here, flattening out until we can move higher based on the tips yields. Seasonality, we are in June, so expect some weakness here, and next month we will go higher. Same with silver. In June, this is a weak month, and then we can go back up. So if you can, just wait until the end of the month, and then precious metals should do well. As the Charles nanocycle says, that we are having a bottom here in gold. Gold miner bullish percent index was pretty bullish, so we need a bit of a correction here. I think gold has gone up too far. Now we had new deficit numbers out. Latest deficit numbers were actually a little bit better than the month before, but we still have a lot of deficits. Goods deficit is still at record highs, and the services are going down. So the service surplus is weakening. This is a new trend. This hasn't happened before. So services were always going higher, and now it's starting to decline, the services in the USA. So that's a bad sign, but that's good for gold, of course. Trade balance has been improving a bit here, a bit of a bounce in the deficit, but we still have a lot of deficits. And take a look at the latest gap. The gap has actually increased. Import prices are up while export prices are down. So we don't see this gap closing yet. So that means that we still see high numbers of deficits. And the gap can be seen here as well. Capacity utilization was going a bit up, so that's good for gold. But actually it's pretty flat. So you could make a case that inflation is a bit subdued. We should see higher capacity utilization for more inflation. But when we look at this chart, you can see that producer prices are skyrocketing. This is the April PPI. It is skyrocketing. So we will see a lot of inflation coming in. CPI is also going up. University of Michigan inflation expectation is going up. This is a very scary chart. The personal consumption expenditures in April was up 28% from last year. That's a very good sign of inflation, if you tell me. We will see 5% inflation next month. That's easily 5%. Money supply, let's take a look at that. Money supply is still going up, so we're still in inflation. There's no sign of deflation. Central bank balance sheets are also going up, especially the European Central Bank, which is going up faster than the Fed. Japan has been doing nothing here, which is very odd. And we will get to Japan later on, as there is some interesting data from Japan. Here we see also very interesting data. So the reserves on the banks are flat, but you can see here the green line is going up. So those are the reverse repos that are going up, which means that there's too much liquidity. They can't get rid of these reserves. There's just too many reserves. So I expect that those reserves will come into play when they issue some infrastructure bill or more stimulus checks to get rid of these reserves somehow. Because they're just sitting there on the balance sheet and nothing is happening to it. I will talk about this later on. But let's take a look first at the central bank gold reserves. We had an update on that. And here you go. Japan has actually bought a lot of gold. Thailand, India, Hungary have also bought a lot of gold. So Japan bought from 765 tons to 846 tons. It's almost 100 tons. That's a lot for Japan, especially Japan never buys anything and suddenly it is buying 100 tons. India has also been increasing each quarter. A lot of green here. Turkey has been selling gold. Also notable, Thailand bought 45 tons. And Hungary bought 60 tons, which is actually a lot for Hungary, such a small country. And the total number is going up by 200 tons. So this is good news for gold. We see that central banks are starting to buy gold. Sprott had also an update on its holdings, and we see that they added to Rio Tinto, so they're going into the iron ore and copper. So I think that copper and iron ore will still be doing well in the future. But they did sell some of the copper mines here, Tech Resources and Western Copper. And they sold the Bank of Nova Scotia. You can look at this yourself and see which companies that you would like to buy. Mostly silver miners I see here. They have been adding to silver and uranium. Now let's take a look at these reverse repurchase agreements, because there has been a lot of talk about that. So what is a reverse repo? Well, there's just too much liquidity on the markets, and also they use these reverse repos to set the target range of the effective Fed funds rate. So let's take a look at the Fed funds rate here. So the red line is the Fed funds rate. You can see that this is going down. So this is going down too much, and they need to bring that back up. So in order to do that, they need to sell it, because if you sell it, then it goes up. And if you sell those securities, then the banks will give you cash. So the Fed is getting the cash in, which drains the money supply actually. So the Fed gets cash, it will sell the securities, and is actually draining liquidity from the system. So that is what is happening, and they have been draining a lot, around almost 500 billion. And actually 500 billion is the limit. So they will need to increase this limit. Otherwise they aren't able to drain more liquidity. And what does this mean? If you drain liquidity from the system, then that props up the US dollar. That's what it actually does. And if they don't increase this and just stay at here, then they won't be able to drain more liquidity from the system. And that would be bad for the dollar. So if nothing happens here, we still have this problem of declining effective Fed funds rate, then the dollar will probably crash. Okay, so we need to watch this and see how this unfolds. You can just click on here, for example, and then you can see the parameters. This needs to change, or else the dollar will probably crash. And that's also very intuitive, because when you look at the effective Fed funds rate, which is this red line, if this goes down, then this means that you get less interest on your dollars, and then it is very normal that the dollar would decline because you get less interest. So that's how you should see this here. Very difficult to understand, but I hope this was a bit clear. Also, we saw that the Federal Reserve has initiated Operation Twist 2.0. So what are they doing here? They are starting to buy more treasuries on the long end. So 10-year yield, for example, and that will push the bond yields lower. Keep that in mind. They are going to push long-term bond yields lower, and they are going to decrease purchases on the short end, which is what they're doing here, pushing up the short-term yields back up and buying the treasuries on the long end. So they are effectively trying to get the treasury yield curve back flatter. They are flattening the yield curve. And they are doing this across the 7 to 30-year coupon range, increasing it by 3 percentage points. And here they will decrease them modestly. So this is just yield curve control that they are doing. And that's also why the 10-year yield has been so flat recently. And this will actually benefit gold. Also, Biden had released his budget forecasts. Let's take a look at what he's proposing. So he assumes 4.1% unemployment rate, which is actually lower than today. And that's a very optimistic assumption. Also, we see that inflation is only 2%, which is ridiculous. We are already at 5%. We see that the debt will stay at 117%, which is also ridiculous. And then we see debt being added. So debt is going to increase. They're not going to pay off debt. The debt is just going to increase, which is very good for gold. Deficits continue. They say that they will narrow the annual deficits, but we will still have deficits projected in the budget, which is of course good for gold. And this is the most important here. The 10-year yield is going to be at 1.2% this year. 1.2%. And then 1.4 and 1.7 next year and in 2023. Now, what is the bond yield today? It's 1.6. Very important. So he sees that bond yields will be going lower to in the next months and next year. So what does this mean? If bond yields go lower and inflation goes higher, that's good for gold, okay? Because the real interest rate is going down. Please understand this. We are now at 1.6 and it will go lower. That's the forecast. CPI is 2.1. Okay, that's probably too low. GDP 5.2, 4.3. I also think that GDP will probably be higher than usual because of the reflation trade. They would pay for infrastructure, so get into copper, get into iron ore. I also heard that Biden is putting some money into semiconductors, so get into the tin play because tin is very important for semiconductors and it is in short supply. Negative real interest rates, okay, so that's good for gold. So all in all, I think we are ready to go higher. We had a bounce and we should go higher into the end of the year. Keep an eye on this here because the gold forecaster index is saying that the growth in gold will slow down. It will still go up, but it is slowing down. So don't expect gold to shoot up. It will probably just grind higher like this. And I hope you like this update and I'll see you in the next video.